good afternoon. At the outset, let me welcome you all to another edition of our Informatics program, what we have been calling for quite some time, Reading Between the Lines. Now, this series of Reading Between the Lines focuses on the Indian economy and the banking sector, views and vistas. As most of you are aware, these are difficult times, these are challenging times, times of great turbulence, and obviously the banking sector, which is a miniature model of the broader national economy, could not have remained unaffected by the ravages of this once-in-a-century pandemic. So let me begin in these difficult times with a quote from Albert Einstein, who has been widely acknowledged as one of the leading towering intellectuals of the present era. Einstein wrote, and I quote, "You cannot solve a problem at the same level that it was created. You have to rise above it to the next level." So before we come to the presentation, I would like to share with you that we have structured our presentation in 4 parts. First, we look at what are the factors which are driving the economic revival at the national level. We also briefly discuss global and domestic sentiments, what could be the measures taken for facilitating steady growth ahead, and how the banking sector could work as a catalyst for growth and transformation. Now, let me attempt to identify and isolate some of the basic factors which are driving economic revival today. Most of you would be aware that last year, when I say last year, I mean the last financial year. In India, we follow the financial year from April to March. It was terribly bad in the sense that in first quarter, April to June last year, we had a GDP contraction of 23.9%, followed by the second quarter, July to September, where we had a contraction of 7.4%. Now, this placed India in a very difficult situation in what is sometimes known as a recessionary phase. Let me clarify here that there seems to be some kind of a confusion about the interchangeability of the concepts of a slowdown in economic growth and a recessionary phase. Technically, in economics, finance, we define a recession as a period in which there are 2 successive quarters of a contraction, of a shrinkage, not just a slowdown, but a contraction of a shrinkage in GDP terms. Because of the massive hit caused to the GDP in the first 2 quarters, obviously, subsequently going forward, there was some kind of a pickup in Q3 and Q4, but still, the Indian economy ended the financial year 2021 with a GDP contraction of 7.3%. Now, to place matters in a proper historical and comparative perspective, I would like to submit to you that this was the first time this happened in the Indian economy after a gap of well over 40 years. Prior to this kind of a contraction happened way back in 1979. So it is important to remember this for some sense of balance and perspective. Now, if we look at the recent figures, what you find that GDP is rising both in terms of YOY, year-on-year basis, and sequentially in the financial year 22. Obviously, the growth in GDP and other macroeconomic parameters in terms of sequential growth is more significant because last year was terribly bad. So YOY, these figures will look good. It is important to remember here that sequentially both private consumption and investment spending rose by 12%, manufacturing and construction 8 to 9% higher than the previous quarter. There was a sharp rise in exports of over US dollar 100 billion. In terms of Indian rupees, it works out to roughly rupees 7.6 lakh crore in Q2. Now, some other positive features are that the capital market, the stock market in India seems to surge from one peak to another, and for the last few months, it has been consistently, the BSE index, Bombay Stock Exchange index, has been consistently at a level of about 60,000 or thereabouts. Obviously, there has been some kind of a fall of about 2 to 2.5% in the last few days, come to about 58,000, but taking a medium term view, we could still perhaps maintain that BSE is at a level of 60,000. There has been very strong tax collection, both indirect taxes and direct taxes, GST, advanced taxes, robust corporate profitability, and what is interesting is that we find shortage of skilled laborers, which reflects rising jobs again in the formal sector. Now, advanced tax collections, which is a reflection of the macroeconomic growth, surged from rupees 3 lakh crore in April-December 2020 to rupees 4.6 lakh crore this year. Profits rose because of austerity drive, higher production and capacity utilization. Higher government expenditure also contributed to raising the growth levels. Net direct taxes grew by over 60% to rupees 9.5 lakh crore, that is 85% of the budget target of rupees 11.08 crore for FY22. With better data mining and analytics, use of GST data with audit trails, plugging of gaps and exemptions, and broadening tax base, direct taxes could swell even further. Now let me attempt to highlight one issue of considerable contextual significance, because there has been some kind of a disconnect between the India's real sector and the equity markets, capital markets. India's growing disconnect between certain segments of financial markets and the real sector conforms to the global trend of exuberant equity markets despite ebbing consumption, plunging consumer confidence, and rising debt levels of the government, corporate, and households. Surging stock markets, usually attributed to unlocking, strengthening growth, liquidity infusion, higher savings because of greater uncertainty, and free fall in the deposit interest rate. Everything is certainly not hunky-dory, and there are issues of great concern. Some of the major headwinds which the broader macroeconomy is facing at the present juncture relate to the position of the informal sector, position of the micro, small, medium enterprises, MSME, and a larger range of contact-intensive businesses such as MSMEs, aviation, tourism, logistic and hospitality sectors, services, construction. All these factors and forces have hampered economic growth with distributive equity. By and large, it can reasonably be maintained that IT-intensive activities have generally fared far better. Now, we maintain, and there are justifiable reasons for it, that the economy is clearly rebounding. Why do we say that? Let me attempt to identify and isolate some major aspects of this rebound in the growth economy. If we look at September 2021 collections of GST, this was at 1,24,000 crore, which was at a 5-month high. There are strong indications that this kind of a rise is here to stay, and going forward in the months ahead, we will see even a further higher rise in the levels of GST collection. Corporate bond issuance was on the rise, suggesting business recovery. September 2021 figures stood at about 83,000 crores. Capital market, as I said, all-time high, BSE breaching 60,000 levels. FPI, foreign portfolio inflows comprising debt equity, rose again. September 2021 figures stood at $3.8 billion US. Moderating G6 helped in recovery process, and the September 21 figures stood at 6.16 levels. Core sector output was even higher than the pre-pandemic levels. In August 21, we recorded a growth of 11.6%, and forex reserves. India has been consistently doing very well in this aspect. September 21 figures show forex reserves of $639 billion. Fiscal deficit has been an area of great concern. It has evoked considerable debates and discussions across the development spectrum. But fiscal deficit figures are not so disconcerting because the October end we had a fiscal deficit of 5.747 lakh crore, which constituted 36% of budget estimates because of surging tax collections. Gross tax revenue is likely to exceed budget estimates by rupees 1.8 lakh crore. November GST surged by 25% to rupees 1.31 lakh crore. Going forward, we expect GST to stabilize at a level of even 1.3 to 1.4 lakh crore per month. GST collections have been driven by higher system capacity, inducing non-filers to file tax returns, blocking of e-way bills, and passing of input tax credit to non-filers. Higher collections from major states range from 18 to 30%, and higher input tax collections suggest robust growth. Another important factor which is likely to provide an impetus to the process of growth is the fact that declining pandemic and rising vaccinations. There are some estimates which suggest that most of the adult population in India has been covered by the process of vaccination, and this pandemic is also losing steam, so to say. We have the Omicron virus, but by all indications, it's considered to be a much more milder version of the COVID-19 pandemic, and certainly much milder than the Delta variant which we witnessed last year. Now, our basic thesis here is that the worst is clearly behind us, and there is a clear level of upswing, a rebound in the Indian economy. This thesis can be substantiated by high frequency indicators such as power consumptions, tax collections, but there are some areas of concern also, and these concerns stem from supply disruptions, rising input prices. Omicron virus also, as I said earlier, causes some concern. While the austerity drive, which was on in most companies, drove profitability in large companies, there is a need to sustain the growth momentum. The Reserve Bank of India has also highlighted that despite Omicron concerns, upbeat consumer and business confidence, rising bank credit, resilient aggregate demand, higher Rabi sowing augur well for the Indian economy. Rising vaccination facilitated demand transmission from goods to contact intensive services and real estates. But one important area of concern, not just in India, across the globe, particularly in India, we find that even earlier we had a position of inequality, consider stark inequalities in distribution of income and wealth. But in this post-pandemic period, this skew in income and wealth has obviously accentuated, aggravated, which causes concern. Growth has been powered by IT services, autos, pharmas, mobile phones, and technology startup with huge financial inflow. Sustainability depends on health of corporate balance sheets, world growth, policy certainty, and domestic growth. In this process of economic revival, there continue to be some persisting issues which cause concern to any right thinker, right thinking person, or any well informed person about the Indian economy. Such concerns stem from the possibility of a third wave of pandemic, the sustainability of fiscal deficit levels, destabilizing debt to GDP ratio, and mounting corporate and household debt burdens. Another issue of concern which I'd like to highlight is the fact that the inflation level, as seen in terms of WPI, wholesale price index, rose to a 12-year high of 14.2% in November because of higher prices of food and manufactured goods. At this stage, it is important for the Indian economy to focus on all the four engines of growth. These engines of growth in India are related to domestic consumption, government expenditure, private investment, and exports. There has been a position of rising unemployment in India, and this also requires focused attention. Creating jobs is critical to recovery together with boosting demand. Now, how do we go about making India's growth broad-based and sustainable over the medium term? Obviously, if we look at the third quarter figures of financial year 2022, we find robust sales and profits. But a disaggregated examination would clearly reveals that there has been some kind of a skewed growth stemming from metals, oil and gas, private and public sector banks, and technology. In fact, a granular examination of the larger Indian corporate landscape reveals that one-third companies recorded lower profits, which brings into sharp focus the need to broaden growth process. The Reserve Bank of India has shown COVID-reduced consumer confidence with sentiments of household across strata influenced by spread by infections and fatalities. Future economic growth expectations are a function of check on COVID. By and large, most well-informed watchers of the Indian economic scene, whether in India or abroad, are convinced that the Indian growth process is here to stay, also to gain momentum. For example, let me here briefly refer to the views of Lawrence Summers, who is an eminent economist and he has projected that India could grow at 10% for 15 years because of rule of law, entrepreneurial energy, digital technologies, and non-resident Indian diaspora with economic liberalization and political stability. An area of concern today is that the combined debt to GDP ratio of the states could be 31% by March 2022, which breaches the 20% target for FY23 set by the Reserve Bank of India. The RBI has highlighted that state governments must take credible steps, particularly in the power sector, in the realm of power sector, for debt sustainability. Now let me refer briefly here to global sentiments. Global economic prospects are characterized by unequal vaccination across countries, rising inequality across the world, third pandemic wave, inflationary spiral, GDP growth headwinds for US, Germany and China, higher goods prices because of pandemic deficits. Now, in this kind of a broader macroeconomic framework, central banks across the world are forced to straddle growth-inflation trade-off because of supply-side disruptions and cascading prices. Divergent currency movement occurs because of ascendant rising dollar and feeble yuan, the Chinese currency. All this complicates policy making in emerging economies. At the global level, we also find that actions of the Fed Reserve in the US could also throw some kind of a spanner in the works. There is an impending rise in the Fed rate. Fed Reserve is strongly suggested a rise in interest rate in March. Fed is combating 4-decade high inflation and supply chain disruptions post-pandemic and winding down asset purchases to power growth. In some very comprehensive exercises, the IMF shows spillovers caused by tightening monetary policy could be benign, but fast Fed moves to check inflation and taper asset purchases could shake financial markets and tighten financial conditions globally. The Fed is likely move to raise its target rate by at least 25 basis points from close to zero would enhance consumer borrowing costs across segments, and obviously this could have global ramifications. In this kind of a framework, emerging markets must prepare effectively to ward off capital outflows and currency depreciation. There is a difficult policy trade-off between rising debt and inflation of fostering a recovery. There cannot be a one-size-fits-all approach in all countries in all time periods. The response has to be based on the individual circumstances and vulnerabilities of each country. Now let us try to look at the roadmap ahead. At the larger national level, there are obviously macroeconomic risks of inflation, glide down of accommodative monetary policy, and fiscal crunch. And it is difficult to reconcile policy objectives. At the larger level, there are obviously persisting issues of inequality and unemployment. Recently, NSO has projected that India's economic growth could be 9.2% this financial year, which is lower than RBI's 9.5% December projection. There are low base effects, crippled trade, hotel, transport and communications, muted private consumption and investment, and all these factors need to be considered in a holistic examination of the Indian growth process. Surging Omicron cases, spiraling WPI inflation, unfathomable capital market valuations, supply chain issues, and labor shortages, private capex and housing could cloud macroeconomy. Despite fuel cuts, India's November WPI wholesale price index at 14.23%, which was the 8th consecutive month of double-digit inflation, was driven by food, minerals, and fuel products. November CPI was at 4.91%, but higher WPI would eventually raise CPI. Current inflationary prices spiral stems from both demand and supply side factors. Now, at the national level, what you find is that in case of such wide divergence between the WPI and the CPI levels, normally high CPI levels ultimately get translated into CPI levels. But with Omicron and squeezed demand, this pass-through may not occur. However, we would like to stress that there is no one-to-one correspondence between WPI and CPI inflation. India is on the cusp of a revolution with digital payments zooming 160 times in last 2 decades in India. NASSCOM, which is a pioneering institution in this area, has shown that India's sprint to a world-leading digital payments ecosystem by 2025 could create rupees 2.8 lakh crores in economic value and up to 26 lakh jobs. Taking digital innovations to a higher orbit requires breakthrough and digital disruptions, blurring of boundaries between traditional banks and fintech and big technology. This aspect has also recently been stressed by Mr. Rajeshwar Rao, Deputy Governor of the Reserve Bank of India, and requires meeting challenges across levels, across customers, regulators, and supervisors. In the ultimate analysis, sustainable business necessitates healthy corporate practices. Now let me come to the last section of my presentation and look at the position of the banking sector in India. Scheduled commercial banks, what we broadly say as the banking industry, this is not a monolithic category. There are significant differences across public sector banks and private banks, and even within these two groups. Private banks are certainly better placed to withstand post-pandemic challenges. Now, of late, the RBI has reduced the repo rate by 115 basis since March 2020 and the reverse repo by 155 basis points. But for most periods, there has been surplus liquidity in the banking system. Low demand and increased banks' risk aversion kept credit growth low. We have a position of low CD ratio, negative bank credit growth across sectors, decline in credit to major industries. To also some extent, for some periods, there was a downturn in retail and microcredit. Obviously, this has changed of late, and now we find again some kind of an upturn both in retail and microcredit. If you look at the position of defaults and delinquencies, what we technically call non-performing assets in the banking sector, the NPAs are not uniform either across bank groups or across sectors. Going forward, I think all of us are agreed on this basic premise that COVID-19 will have enduring impact across industries, including banks. In this kind of a situation, banks need to be adequately secured with their assets qualitatively strong and amply capitalized. Size is essential, but efficiency is even more so. There has to be shift from transactions based to business orientation. In the commercial banking segment, I think for last maybe 2 or 3 or even 4 decades, most of us seem to be obsessed with the concerns of a top line growth. Now there seems to be an increasing consensus that there has to be a paradigm shift to the concerns of the bottom line, shoring up net profit, and this all banks have to make focused and provide undivided attention on this aspect. Remaining overly risk averse could be self-defeating. Risk propensity aligned with banks' measured risk appetite is the need of the hour. Risk management is going to be increasingly important in the days and years ahead. The basic purpose of risk management being to detect vulnerabilities and capture risk with changed external environment and best practices. Banks have to manage operational risk, particularly controlling frauds, both cyber related and otherwise. Banks should also do well to put in a proactive, a dynamic, effective early warning system and forward-looking stress testing framework. There has to be appropriate compliance culture transcending legal binding with broader standards of integrity and ethical conduct. This has become all the more necessary in the present times. Some of you may be aware that some time back, Habib Bank, which is at one time Pakistan's largest commercial bank, was fined US dollar 225 million by the regulator there. And this is something like a double whammy. Why do I say double whammy? I say double whammy because these days of heightened consciousness of all aspects of risk management, all of us are aware of the concept of credit risk, market risk, operation risk, foreign exchange risk, sovereign risk. But perhaps one important facet of risk management has to be reputation risk. If, God forbid, there is a run on the bank anywhere in the world, given the kind of banking model that we follow globally, there have been large number of studies, empirical evidence on this, no bank could survive for more than 60 minutes. So this is the magnitude of the crisis which could be engendered by reputation risk. So when the regulator finds something like hefty penalty on the banks, this works like a double whammy. On the one side, when banks are not able to generate adequate levels of profits and profitability, obviously their profit pool gets dented. But this is one side of the story. As I think a very Hindi film dialogue goes, picture abhi baki hai mere dost. So the other side of the picture is far more savage, far more debilitating in the sense that it could cause some kind of a reputation risk to the banks. And this has far more savage, grave repercussions. Going ahead, it is necessary to have a good governance framework, effective risk and compliance culture with a strong internal audit. Banks have to focus on proactive buffers building and capital raising, credit flow together with enhanced resilience in the financial system. Here, we must also stress resilience of individual banks and financial entities and financial sector resilience. Banks, NBFCs, non-banking financial companies must assess the impact of COVID-19 on their balance sheet, asset quality, profitability and capital adequacy for mitigation measures, namely capital planning, capital raising, and contingency liquidity planning, etc. As I said earlier, banking sector must not be seen in a silo. It is a microcosm of the broader macroeconomy. And in the last few years, the Indian economy has suffered by a triple whammy of demonetization, the rolling out of the goods and services tax, and now the impact of the COVID-19 pandemic. All this has led to a position of weakened banking, high levels of NPAs and credit growth. Some recent estimates suggest that NPAs could surge to 10 to 13% of loans by the end of financial year 23. In this connection, there has to be a greater thrust on legal and non-legal measures with National Asset Reconstruction Company NARCL, Prompt Corrective Action PCA framework, capital buffers for small finance banks, SFBs, asset reconstruction companies. As I see it, some of the basic issues confronting the Indian banking today relate to modest capital buffers for most public sector banks, high level of non-performing assets, weaker earnings, and subdued growth prospects. Post this COVID-19 pandemic, digital maturity and COVID-19 resilience will determine the strategy of banking players. We see three kind of distinct banking segments emerging. First is banks already future ready with truly digital banking capabilities and cost elasticity. The second would be banks which are making all-out attempts to improve their digital capabilities, and the third is the kind of banks which continue to be laggards in this area. These are difficult times, as I said, these are challenging times, but I am reminded of one of the very powerful lines of the Bible where it says that this too shall pass. Similarly, Fyodor Dostoevsky, a Russian novelist whose novel Crime and Punishment has been a very famous work for well over 100 years, he wrote, "The darker the night, the brighter the stars." Similarly, P.B. Shelley, a famous English poet, wrote, "If winter comes, can spring be far behind?" I am sure that despite these difficult times, the future is going to be bright, and I am optimistic both for the Indian economy and the banking sector. We have faced difficult times in the past, but the Indian economy and the Indian banking sector has always displayed immense dynamism and resilience. I am confident that going ahead in this new normal, we shall once again be successful. Hum honge kamyab. Thank you very much. Thank you for being with us here today. Thank you.